Hey everybody, welcome to May, monthly update time. Lots to cover today. Going to talk about oil prices, going to talk about the war in Iran, interest rates, where the overall market is, and what we think is going to happen. So lots to cover, let's get into it. I'm going to start with the good news. In fact, this whole report is going to be kind of good news, depending on your time frame, I guess. But in the short term, we'll start with the really good news. So we're in earnings season right now. Companies are reporting earnings for Q1, and they're crushing it. So right now, about 65% of companies have reported. 87% of companies have beat earnings by an average of 20%. So that's great. Despite all the stuff I'm going to talk about in a second, the main thing is that if companies can keep doing well, raising earnings guidance, raising earnings, as long as that keeps happening, the rest of the stuff just kind of becomes noise, because that's what really matters, is just companies doing well, having good earnings, and going from there. So secondly, is looking forward to next year. Analysts continue to up their earnings estimates just for like the overall market. So this is a chart of the overall analyst estimates for the S&P 500. So it's every company in the S&P, just the combined earnings of them. So you can see that as time goes on here, the 2027 earnings keep trucking higher. Despite the war in Iran, despite the recession, or potential recession, despite oil prices, despite all this stuff, analysts keep increasing EPS estimates, and companies right now continue to beat current EPS estimates. So all of that is really good. So now what I really want to kind of focus on is what the rest of the year probably looks like, and maybe why that all might happen. So I'm going to start with just where we're at with the market right now. So to get bearings, this back here is the low of 2022. This is the long-term trend line that's held since then, and this is where we're at in the market right now. So you can see that we've had, some pretty sharp pullbacks, especially the last two. Have been, pretty sharp. They've been straight down for the most part, but we've also seen really sharp recoveries. So my kind of personal theory on that is, there's more individual investors in the market now than there has been in the past. Like in the past, the market was generally controlled by institutions, and institutions tend to be fairly risk averse. So if the market looked weak, they would start selling, and then they would just kind of keep selling, and there would be no one really that would want to step in and start buying. But since the pandemic and everyone had some time off, a lot of people started trading. They started trading crypto, they started trading stocks, they just got into the market. Things like Robinhood and Coinbase, and they've all exploded because a lot of individuals have just started trading, not big amounts, they've started trading stocks. They're the ones that are willing to just jump in there when the market's weak and say, you know what, let's buy some stuff because things are cheap now. And that, I think, is the phenomenon that's happening. That's why we're seeing these really sharp recoveries after really sharp declines. So I think that's good. That's great. That's like the long term. That's going to be an excellent way, I think, of stabilizing the market, to give multiple forces out there as opposed to just one big gigantic institutional force that really depends or determines which direction the market goes. That being said, though, I think also we might be in store for more big sharp declines like this, because just like, if there's one big force that pushes something down, individual traders also want to sell to get out of the way of things too. So they're also going to be selling. That's just more pressure put on the downside as well. So that's why I think we're seeing sharper declines, but I think that's also why we're seeing sharper recoveries. So now we're here. Now we've made a really sharp recovery off of that sharp decline, and now we're making new all-time highs again, which is great. But there are some things out there that I'm not sure that the market's necessarily paying attention to, or I think that it doesn't matter to the market yet. And one of the things, and kind of the main thing, is we're still in a war with Iran, and that's not really resolved in any way yet. But the market has seemed to forget about that for the most part completely. I mean, we've seen the market just kind of go up. It's not even really being talked about on CNBC or just like the market buzz isn't really about the war in Iran anymore or oil prices, which I think is going to start to matter later in this year. So if you look at oil prices, they're steadily kind of getting back to all-time, or not all-time highs, but the highs that we were at a few months ago or a few weeks ago. And the market's not really reacting in a negative way to this. And that's a problem. This is going to be a problem that if oil prices stay high for too long, that almost certainly will cause a recession, just because it'll increase the cost of goods sold, it'll decrease corporate profits. It won't be good. There's many smart people out there that say if oil stays elevated for 6 to 12 months, that a recession is going to be hard to avoid. So depending on how long this stays up here, that may have a bad impact on the market. The other thing we're seeing is interest rates starting to creep higher. The market also doesn't like that. So this is the 10-year yield, and this is kind of generally creeping up a little bit. Like the 4.5, 4.4, 4.5, 4.4, 4.5 level has kind of been like the line in the sand where you've seen like it's kind of topped out there since, back in like late 2024. And we're getting close to retesting that again. So the combination of increasing interest rates along with sustainably high oil prices may start to put some pressure on the markets in the kind of like the near term. If we look at the Strait of Hormuz, the traffic is still just at it's at a trickle. Before the whole Iran thing started, there was averaging, I think it was 135 ships per day that were going through there. And now we're down to like an average of, say, 7. And you can see the inverse correlation to oil prices going up with the amount of ships going down. We're just not seeing this improve yet. Even though, we've offered to escort ships through the strait, I don't know how realistic that really is. I don't know how many warships we have that can actually do that, but it doesn't seem to have an effect on shipping numbers yet anyway, which is why I think oil prices are staying higher. But that being said, again, if analysts see earnings estimates going higher, like that's what matters in the long term. So what I think we should prepare for is for the rest of the year to look something like this. I think we probably are able to trend a little bit higher in the short term, but I think that in the early to mid-summer, I think that the combination of higher oil prices with higher interest rates will start to matter to the market, and I think that is likely going to cause us to have what might feel like a bear market. Might feel like kind of an ugly market for maybe a little longer than these last two times have, to where this long-term trend line may come into play. It might be a little bit more protracted, and this all depends on if the Iran situation gets resolved. If oil prices go back down to where they were before, this scenario is probably not going to happen. But if it doesn't, this scenario is in my opinion, likely. But again, that being said, I think that happens for a little bit, and then I think the market will bounce, and I think we'll make new all-time highs again, and probably significant new all-time highs as we get into the end of this year and then into next year. So the market's probably ready after 3 years of being green to have more than a couple weeks of sharp down. And there might be a few months where the market's just kind of weak, and that's fine. That happens to the market. But if we can get that out of the way, in the middle of this year sometime, and we can start the recovery into next year, based on where analysts think earnings estimates will be next year, that could be a very, very good set. That could set up the next 3 years of green markets. So that's kind of what I think is going to happen. And again, if you look at how interest rates correlate to the overall market, like if we look at the 10-year yield, the last time that we had a 10-year yield real spike was back kind of at the end of 2024, beginning of 2025. And you can still correlate that right back to right here. Like this is the end of 2024, beginning of 2025. Like a rise in interest rates sometimes tends to lead to a fairly sharp pullback in the market. And you can see that interest rates tend to go down with the market. Like if you look back at what happened to rates after this big spike, they went kind of straight down just with the overall market. And the reason it happens is because when markets start to look weak, investors start buying bonds. And when people buy bonds, the prices of bonds go up. And if the prices of bonds go up, the interest rates go down. So that's why we see rates go down as we see markets go down. So that's what I think is likely on the time horizon. Interest rates, it'll be interest rate dependent. It'll be oil dependent. And neither one of those are really clear how they're going to shake out. But that's going to be what matters. So we'll keep an eye on it. But in the meantime, markets are at all-time highs. Analysts think earnings estimates are going to be at all-time highs next year. So party on for now, and we'll see what happens next month. As always, if you want to get together and chat face-to-face about your portfolio, let me know. Otherwise, if we don't hear from you, we will talk to you in a month. Hope everyone's doing well. Talk soon.